So a lot of people that have joined the stock private have expressed that they're beginners or they're fairly new to the stock market, and they don't really have much of an understanding as to how to approach the market, what to look for in the market, sort of how to develop their own identity in the market. What like they don't know what they should do, how they should invest, which direction they should go, and that's totally fine. That's how I was when I started. So I just made this little kind of intro to the stock market PowerPoint to sort of give you guys an idea of like the differences between investing and trading, like the mentality you should have in the market, some tips and tricks, and some like brief introduction exposure to different trading methods and different and then options trading too. So this PowerPoint is kind of going to touch on everything, and from this, you can sort of have a grounding, a base as to how to approach the market. And if you have any other questions, you could do further research into these topics, or you can always ask me. I can always try to answer to the best of my ability. Like I said, for me personally, I am not a professional trader. I cannot offer financial advice, but I can offer my knowledge as to the situation, what I do know. Like you guys, I'm constantly learning every day, and I don't have an answer to everything. So, but I do have enough knowledge to sort of pass on to you guys starting off, so we can sort of build a basis and sort of work our way up, so we can all make some money. So, intro to the stock market. So, to start off, what is the stock market? So, the stock market is an aggregation of buyers and sellers of stocks, which can represent ownership claims of a business. So, public versus private companies, what is the difference? So, the stock market is essentially it contains publicly listed companies. So these companies have gone public, and therefore, when a company has gone public, you can buy shares of a company. So the share of a company is sort of like you own a part or a stake in the company. Think of like a square, right? So you have a square, and that's your company represent. That's the represented company. When you buy one share of a company, you buy a piece of that square. So now you own a piece of that square, therefore you own a piece of that company. Albeit, it doesn't matter how big or how small, you have ownership stake in that company. However, publicly traded companies are the only companies that offer this. If you have companies that are private companies like Lilium comes to the top of my mind. To invest in those companies, you need to go through different forms and avenues like becoming a venture capitalist in order to take on those sort of investments. And that's not really what we're concerned about. So the only companies you can invest in the stock market are companies that are public. So these are your common ones like Apple, Microsoft, Tesla. These are all publicly traded companies. Since they're publicly traded, they are open to the general public for you guys, for us to invest in. How can you invest in a company? So you can invest in a company multiple ways. The most common way and the most appreciable way of investment is by buying shares. When you buy shares in a company, like I said, you take a stake in an ownership claim in that company. The more shares you buy, the more expensive your stake becomes, but also the higher return of investment. So, say if you buy one share of Apple right now, Apple's trading at around $140 a share. You have to pay $140 to own one share of that company. Now, if you want to buy, I know this came to Robinhood, you can own fractional shares as well. Fractional shares are essentially you own a piece of that one share, so a fraction of a share. So you will still have ownership of a company, but it'll be very small. But it's beneficial to those who have a lot less buying power, who want to own a part of the company. So a lot of people I know have fractional shares in Tesla. Tesla has reached levels that are very, very high and exorbitant and out of most people's price ranges to own just shares. So people will buy fractional shares, and whenever the stock goes up, their fractional share worth will also increase as well, given the underlying of the stock is increasing in price. So, investing versus trading, which one will you choose? So there's a key difference in the stock market. You're either going to be investing or you're going to be trading. So investing is taking an active stake in a company, holding shares and sort of riding along, collecting a return of investment. Trading is a little more different. That involves more frequent transactions, which involve buying and selling different like options, different shares, all that. So we'll get into more of a breakdown of each one. So, before we get into it, we need to understand the rules of the market. So, it doesn't matter if you want to trade, it doesn't matter if you want to invest, it doesn't matter if you even just want to watch the market. Before you enter the market, there are four main rules that you have to follow. Number one, Only put in how much you are willing to lose. This is an extremely crucial rule and one that is by far the most important one. If you only have enough money to lose $100, then you should only put $100 in to invest or to trade. Basically, when you want to think about how much money you want to put in, you want to think to yourself, okay, if I put this amount of money in and I lost all of it, it won't affect me in any way, shape, or form. So if that might be $50 to some people, that might be $50,000 to some people. That all depends on your risk. If you put in $50 and you know that tomorrow, if you wake up and you lose all your $50, it won't affect your well-being or your financial situation at all, then that's the right amount for you to invest in. So only put in how much you are willing to lose. Number two, handle your money and your money only. Do not provide financial advice unless you're a professional trader. Again, whenever I call out plays or whenever I give information, you will always see a disclaimer or me mention that it's not financial advice. I'm not a professional trader, because at the end of the day, I cannot tell you what to do with your money. What you decide to do with your money is your choice. People like me, when I provide information or when I provide trading opportunities, like say I provide a contract or a trade I'm going to enter, that's just my personal thoughts and what I would do with my own expenses. It is not a directive to other people to make that same exact play, because then that would give responsibility to me. They would have to shift responsibility to me, and that is not something either party would want. So only trade based on how you want to deal with your money. If I give a call out and you guys don't like, that person doesn't agree with that call out, they shouldn't be investing in that trade. Number three, the market does not care what you think. We only care about what the market thinks. This, no matter how much you are on the top of the world, this will come out and win every single time. The market does not care what you think. You may think that Apple is going to go up tomorrow because of good earnings reports, as an example. The market doesn't care. The market will react to certain news and events and movements based on how it wants to. People have you. There has to be a realization that there's a lot more at play here besides just us trading, because you have to take into account there's institutions that are buying in, there's hedge funds, there's banks. You have a lot of bigger players with a lot more money and power in the market. So the market moves based on how it wants to react to the news and how it wants to move. It does not care about what you think or what you want to move. So that is important because once you acknowledge that and realize that, you can ride different waves of the market based on what it is thinking. And then lastly, you want to mitigate your risk, but you want to realize your profits. So you want to decrease your risk whenever you're entering the market as much as possible, but you want to maximize and increase your profits. And when I say realize your profits, that means once you are in the profit in a contract or in a trade or an investment, then it is recommended that you do take that profit, because those profits can be wiped away. Now, if you're in a much safer investment, like you're investing in an ETF, this won't apply as much because you have a lot more exposure to a diversified portfolio, and since it's much more diversified, you have a lot more protection against severe drop-offs and potential, big losses. This risk mitigation and profit realization is especially important for those who trade options, which we'll talk about later in the presentation, because that options trading can see massive swings and changes in your portfolio. So some basic stock market lingo. So whenever you see whenever someone is calling or is long or is bullish on a stock, that means they think the price will increase. Whenever someone is short, they're getting a put, or they're bearish on the stock, they believe that the price will decrease. EP stands for entry point. That's when you enter into a trade or an investment. PT equals price target. That's the price you think the stock will hit. SL equals stop loss. So a stop loss is essentially one way to mitigate risk. People will set a stop loss, so that if the stock falls to that price, your brokerage will sell it for you right away. So if you only want to lose, so say you invest in something and it costs $10 and your stop loss is 10%. So that means you will only want the stock to go down $10 before the brokerage will sell it off for you. So exercising, so this is for an options contract. That's when you purchase the underlying shares. So say you have one contract of $100 stock. The thing is, you have 100 shares in there, so you're gonna need $10,000 to purchase all of those stocks, all those shares. The PE ratio is, or the price to earnings ratio, is a company's share price compared to the company's earnings per share. So the higher the ratio, it could signal more an increase in investor optimism. IV is implied volatility. So this is basically an uncertainty of where a stock is heading. This is more applicable in options. However, it's good to keep track with when you invest, because if there's uncertainty, that can imply that the stock can either go up or down based on news, especially in earnings reports. And then open interest is the amount of contracts options that are currently open at that time. So, how to determine a good investment? So, if you do decide that you want to invest more instead of trade, you need to ask yourself, what do you want to gain from your investment? Do you want to have stability? Do you want to maximize, coverage against losses? Do you want to increase potential for rewards, which means also partly an increased risk? Do you want to sort of gauge your investments that are dependent on future changes in innovation? So there's a lot of questions one must ask themselves before they go into invest in company. So from there, once you make your decisions, you can compromise a list of companies or ETFs that you wish to invest in. So if you're interested in a certain stock, fundamental analysis is crucial. I do discuss it later, but essentially what fundamental analysis is you do a complete overview of the company at hand. So say you want to invest in Apple. So fundamental analysis would include going over what the company has to offer, how their earnings is looking like, their financial sheets. So how much debt do they have? How much revenue do they have year to year? So looking at all of that, looking at what they have in place for the future. So all of those sort of compromise fundamental analysis, and it gives you a gauge on how strong the company is. That's what you want to find out. And typically for investments, you purchase your shares and you set them aside to let the company grow. Um, does not you don't really, if you don't have as much time to take an active position in your portfolio, you want to invest, you can purchase these shares and just not even check your portfolio, especially if you're in an ETF, which we'll talk about in the next slide. Because you're basically trying to you want to be a value investor, so you don't care about short-term movements, you don't care about what the stock's going to do tomorrow, you care about what it's going to do in 10 years. So a company like Apple, tomorrow they might go down, but in 10 years, we know that they want to release a car in the next 6 years and all that. So you know that in the next 10 years, they're going to be very profitable and have a lot of positive things coming out of the company. So compared to today, you think the price of the stock is going to be much higher. So you're in it for the long haul. So some examples of investments, blue chip companies. So these companies are, Microsoft, Apple, Coca-Cola, Intel, Disney. There's a surefire return. You know they're going to bring a return in your investment, but because there's almost a surefire return, you have more expensive shares. So again, all of these stocks, I know Microsoft, Apple, Coca-Cola all range in the 100 and up. Intel's the only one that's under 100. It's around $50, I think. However, they also return a low dividend yield. So dividends are essentially companies pay out dividends. It's sort of like a payment to shareholders for holding shares in the company. They pay you to hold shares, so you get a cut of the earnings from that company. Blue chip companies have much smaller dividends compared to other different types of companies. Another type of investment is an ETF. So this is like a basket of securities or shares which are sold on an exchange. So they combine features and benefits of mutual funds, bonds, and stocks. So basically, this is a very diversified holding. And if you invest in the ETF, you're basically investing in a bunch of companies, but in smaller amounts. So for me, my favorite ETFs are the ARK ETFs. Those include ARKQ, ARKK, which is their innovation ETF, ARKF, which is their financial tech ETF, ARKG, which is their genomic revolution ETF. So each of these ETFs hold a basket of companies that have a lot of influence in that area. So for the Genomic Revolution ETF, or ARKG, that's an ETF that contains a bunch of companies that are big in the genomics section, like gene editing, therapeutics, treatment, and because of that, you're gonna have much more exposure to a bunch of more companies. So therefore, you're gonna have a higher return of investment, but you're also gonna have low risk. And you can invest also in small cap stocks with higher potential for a solid return of investment. These stocks kind of include NNDM, GEVO, OEG. These are much smaller stocks that are going to have a big impact in the future. So they're a little more riskier, but they're also very solid plays there where they have a lot more potential to increase in a shorter amount of time. Therefore, you'll have a lot to make in your investment. The art of trading. So now, for those who decide to trade, it's for those who make more frequent transactions and they want a higher return of profit. So investors typically make around 10 to 15% every year, while traders can sometimes shoot for 10 to 15% in a week. A trader style is the method they utilize to trade. They include position trading, which is where you hold a position over various months, even years before you sell. Swing trading is when you buy a position, either shares or options, and you hold for a few weeks and you try to sell it at a higher price. Day trading is where you buy shares or options contract at the beginning of the day or at some point during the day and sell later in the same day for profit. And then scalp trading is when you want to try to scalp some profit on the way up or down of a stock. So like GameStop today rose from $45 to $75. So me personally, I was able to scalp some profit in the middle of that rise. So like it's like you can get in during the ride up and you can get out during that same ride up and make some profit. Um, you can determine your style based on account size, time available to spend on the market, your experience, and risk tolerance. So I put a big deal next to risk tolerance because if you have higher risk tolerance, you need to also have measures in place to help capture and rein in that risk. So for me personally, I'm a swing trader. So I have my trading plan really consists of me shooting for about 40% profit. So if I make 40% of my initial investment, then I'll usually sell. But if I lose about 15-20% of my initial investment, that's when I'll cut. When you have these tight losses and you have tight percentages in place and you follow it, you become more profitable in the future and you start to develop a technique because at the end of the day if you are trading you want to compound smaller gains because those will add up quicker. It is very easy to fall into a deep loss because you're holding and you want the stock to go up, but like we said earlier, the stock market doesn't care what you want, we care what the stock market wants. So you want to have these safeguards in place to make sure you don't get caught from FOMOing or from missing out on a trade or holding on a trade too long because of what you personally feel. And then a tip also that I've learned is you never hold through earnings. You do not want to hold through earnings.